This video will explain why 30-year US Treasury bonds, otherwise known as T-bonds, are one of the best investments while interest rates are high, and why T-bonds are better than exchange-traded funds based on T-bonds. Treasury bonds are long-term treasuries currently issued with terms of 20 years and 30 years. In this video, I will explain why 30-year T-bonds are the better deal, and why they are now better than Treasury bills and Treasury notes, and most other types of investments. T-bonds are issued only in electronic format. As federal securities, interest is taxed by the federal government, but not by state or local governments. Right now, treasuries have the highest yields since 2007. Although shorter-term treasuries have higher yields, longer-term T-bonds have yields almost as high, and they have several advantages over shorter-term treasuries. In this table of recent auction results, the high yield for the 30-year T-bond is more than 4.8%. Note that the coupon rate is 4.125%, but this T-bond was purchased at a discount of slightly less than $89 per $100 of face value. So the high yield in this table equals the yield to maturity, which accounts for both the coupon rate and the discounted purchase price. One of the main benefits of the 30-year T-bond is that there is no reinvestment risk for 30 years. The interest rate is only good for the term of the bond. When the bond matures, then that money must be reinvested to continue earning interest income. But if interest rates have declined, then the interest rate on new bonds will be lower. This is called reinvestment risk. Long-duration bonds also have the greatest capital gain potential. Since the 30-year T-bond has a long duration of 15.5 years, it will increase in price when interest rates decline. To calculate the approximate capital gain potential of 30-year T-bonds, I constructed this table by calculating the present value of an equivalent zero-coupon bond with a duration of 15.5 years. This table shows how much the present value of the T-bond increases as interest rates decrease from 5% down to 0.25%. The more interest rates drop, the higher the capital gain. If interest rates drop to 3%, and they are likely to drop to at least that level, then the 30-year T-bond should increase by at least 35%. The calculations I presented in the previous slide are only theoretical, but this screenshot shows long-term real prices in the secondary market. Notice that the first T-bond in this table has a coupon rate of 1.25% and matures in 2050. This bond dropped in price because interest rates have greatly increased since it was issued in 2020. Note that the price is less than half of the $100 par value of the bond. This shows how much bond prices can change with interest rates, especially bonds with a long duration. So a T-bill with a yield to maturity of 5% would more than double in price if the federal funds rate fell to 1.25%. If you want more details on how to calculate the capital gains potential for any bond or fund based on bonds, check out this video. The link is provided in the description. Why will interest rates decline? Because current interest rates are far above the neutral rate, which is the interest rate that neither stimulates nor slows the economy. When the interest rate is above the neutral rate, then the economy will eventually slow, which will cause the Federal Reserve to lower interest rates to optimize the economy. However, it takes time for the economy to respond to changes in interest rates, and sometimes the economy slows too much, so the Federal Reserve will lower interest rates even below the neutral rate to stimulate the economy, which it has done many times before. Here's a graph of what the Federal Reserve currently thinks the federal funds rate will be in the next 2 years. Note that it declines to about 3%. However, shocks to the economy, such as war, can send interest rates a lot lower, or the economy can contract more than expected, overshooting the optimal rate to a lower rate of economic activity, or there could be another pandemic. There are several exchange-traded funds based on long-term treasuries, such as the Vanguard Long-Term Treasury ETF. ETFs have the advantage of being more liquid, meaning that they are easier to sell, but they also have disadvantages. To better understand the difference between T-bonds and ETFs based on T-bonds, you must understand the idea of yield to maturity and how it can change. If you buy a bond for a price different from par value, then there will be a gain or loss when the bond matures. Yield to maturity incorporates this gain or loss. If you pay less than par value, then the yield to maturity will exceed both the nominal and the current yield, because you will have an additional gain on the principal. If you pay more than par value, then the yield to maturity will be less than the nominal and current yield, because you will have a loss on the principal. Yield to maturity calculations are valid only if the bond is held to maturity. If the bond is sold before maturity, then the YTM for the bond will depend on the sale price and the remaining term of the bond. The yield to maturity for single securities, such as T-bonds, does not change if held to maturity. Treasuries are usually sold at a discount because the coupon rates of treasuries are set to multiples of 0.125%. So the US Treasury will set the coupon rate to the highest multiple that is still less than the corresponding bid price. Then it will set the price of the Treasury at a discount so that the yield to maturity, what the US Treasury calls the high yield, equals the yield corresponding to the bid price. However, the yield to maturity for ETFs will change continually as the portfolio holdings of the ETF change. Here, you can see that the turnover rate for the Vanguard fund is 19.2%, and the average coupon rate is only 2.9%. The current price of the fund is low enough to give it a yield to maturity of 4.9%, but this will change with the price of the ETF and as the composition of the ETF changes. So a big disadvantage of exchange-traded funds is that they are usually composed of bonds purchased at different times with different yields, and new bonds must be continually purchased to replace maturing bonds and to pay for redemptions. So when interest rates start declining, the newly purchased bonds for the ETF will have lower yields, which lowers the overall yield of the ETF. By contrast, a 30-year T-bond with a yield to maturity of 5% will yield a return of 5% over the entire term of the bond, and the coupon payment will never decline. Treasuries can be purchased in the primary or secondary market. The primary market is the weekly auctions conducted by the US Treasury. These auctions determine the yield to maturity for Treasuries, but most retail investors do not bid. Instead, they must accept the non-competitive bid, the price set by the primary dealers who are permitted to bid in the auction. One problem with these auctions is that auction prices are not known until after the auction. However, you can get an idea of approximate yields by looking at the yields for futures of 10-year Treasuries. This Treasury yield closely parallels yields for longer-term Treasuries. Remember, bond prices move inversely to yields. When yields rise, bond prices decline, and vice versa. Since futures for the 10-year Treasury is expressed as a yield, prices will be inversely proportional to the yield. Here's a comparison between U.S. 10-year Treasury futures and the Vanguard long-term Treasury ETF. Note that when the yield is higher, then ETF prices based on Treasuries are lower. So the higher the yield in Treasury futures, the lower the auction price will likely be. And as you can see, the long-term yield has rapidly increased recently. The yield in 10-year Treasuries was below 3.3% in April 2023. The yield, as of mid-October 2023, is over 4.9%. This means that long-term Treasuries are being sold at the lowest prices in almost 2 decades. The bond market anticipates that the Federal Reserve will not increase interest rates any further, except for a small chance of another 1/4 point increase, so Treasury prices will not drop much further. 30-year T-bonds are auctioned every month by the U.S. Treasury. Some of these auctions are reopenings, which are simply auctions of previously issued securities. The auction is announced in the first week of the month, then takes place in the second week of the month, as you can see in this example. The issue date is the 15th of the month if it is a business day, or the first business day after. You can buy T-bonds either at TreasuryDirect or at most brokerages, but you must have an account at those institutions. You must have an account at TreasuryDirect to buy at TreasuryDirect. Individuals, corporations, estates, partnerships, and trusts may have a TreasuryDirect account. The issue date follows the auction date by a few days. The securities are received on the issue date and the account with the bid. However, you won't know the price until after 5 p.m. Eastern Time on auction day, although you should have a ballpark estimate based on the federal funds rate and previous sales. If you bid through your TreasuryDirect account, you can see the results of your bid after 5 p.m. Eastern Time on auction day. In your TreasuryDirect account, select current holdings, pending purchases, then reinvestments. The price you see is for each $100 of your bid. Each auction announcement includes securities being offered, total offering amount, auction date, issue date, maturity date, and other relevant information. You can learn about upcoming auctions by getting on a mailing list at TreasuryDirect, by checking the TreasuryDirect website, or by checking major newspapers. You can buy T-bonds at most brokers. This screen shows some menu options for some well-known brokers. You will usually find T-bonds in the sections on bonds and CDs. Brokers will give you the option to buy in the secondary market or through auctions. Your selection will be limited with either option. Securities in the secondary market change continually, but even new issues will only be available at certain times, so you may have to check back at different times to buy particular treasuries. This is a disadvantage of brokers over TreasuryDirect, since TreasuryDirect allows you to schedule your purchase of T-bonds at any time. Brokers usually only display treasuries for sales that have already been announced, then take down the listing after the auction date. So, in this example, brokers will list the upcoming auction for the 30-year bond between November 1st and November 9th, 2023. This is when you must submit your order. Now may be the best time to buy. While yields may climb, they will not climb much higher. but they may also decline. Global uncertainty or uncertainty about the stock market may cause bond prices to increase at any time, what is called the flight to safety, as we saw recently when bond prices spiked at the start of the Israeli-Gaza conflict. Bond prices will also rise when most people expect that interest rates will start decreasing, even before they actually do. This may easily occur with the next government report indicating that inflation is declining enough to satisfy the Federal Reserve. No one can time the market exactly, but right now, bond prices are as low as they have been in a long time. But regardless of the exact price you pay, T-bond prices will go up much more within the next year or two, so you should not worry about buying at the bottom of the market. You are at least buying near the bottom. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.